Hi, this is Michael Carlin, president of Henry and Horn Wealth Management with your Manage the Funds podcast. This is your 2019 market outlook. We're going to take a look at all the data, the charts, the information, we're going to wash the spin away. We're going to do as we normally do every quarter and bring to you what we think is most relevant given the market, the economy, and help you understand our view of the market so you can drive yourself forward. Today with us are two very special guests, two friends of mine, two people who manage Tiber Kosmala. We've got Joe and Phil. Guys, thank you so much for joining us from Denver via Skype. I really appreciate the time. We are very fortunate to have them. Tiber Kosmala is not only our outside CIO, our chief investment officer firm, but they are a multi-billion-dollar institutional asset management firm that provides us with insight, expertise, negotiating institutional contracts, wisdom. I could go on and on and on. We could spend 30 minutes about how great you are and all you do for us, our clients, and our firm. Again, I thank you both for joining us.
Happy to be here, Michael. This is Joe Tiber. Really happy to talk to you and all your clients. The only correction I'll throw your way is we are not coming to you from Denver, Colorado.
Oh, from
Chicago.
Chicago, right. Yes.
Just flew back.
Yes, right. I got it. Yes. Sorry about that.
Which you having been here last week with your beautiful son.
I know. It's a lovely office. The best view in Chicago, by the way, from any one of the windows around your office. I especially like the view of the jail. All right. So with that, before we get into a lot of the data about economic data, one of the things I did want to touch on is the government shutdown. Before we get too deep into the weeds about where we are economically, I do think we just want to deal with the one that hopefully will be short-term in nature. It's hard to figure out exactly how much this government shutdown is going to cost us, but what I saw, Standard & Poor's put out research that said $1.2 billion of economic value lost each week. And if that's the case, and if those are really the numbers, it looks like on a little bit more than a month, we're losing about 0.5% of GDP potentially, which could be, if those numbers do indeed pan out, it could be something that is particularly detrimental to the economy. I'm just curious, because I feel like it's going to be short-term in nature. Maybe I'm just judging that based upon other government shutdowns, but what do you guys think? How are we doing? Is this going to really be a big of an impact we need to pay attention to?
Yeah, thanks, Michael. That is definitely something that's growing more and more on the radar with each passing week. Not each passing day, I'll be honest. Government shutdowns, looking at this, it's happened multiple times going back over the last 20 years, and never really has it had much of an economic or certainly financial market impact. So when it was announced, it really didn't hit our radar too much. But now that we're several weeks in and looking potentially at several more, we're starting to hear a lot of our managers that we talk to and a lot of the research vendors that we consume bring it, I guess, up a bit more on the priority scale. But it's still, I guess, the party line still is that we're still looking mid-February to mid-March before I think the economy really starts to become a little bit anxious. We've not seen any financial market disruption, I don't think, as a result of the shutdown. I think the financial market volatility is, stemming from other areas in the economy and with monetary policy. So very much on the radar. But the 1.2 billion, I didn't have that number. That 1.2 billion a week in the grand context of a $20 trillion, GDP, that probably isn't too much of a consideration. Now we don't want to discount, the whatever 800,000 people, I believe, that are working right now without paychecks or not working, for that matter. So something to think about. Phil, I don't know if you had any other talking points on that.
I was part of the 1995 shutdown when I worked at the government, so some perspective on that. We did get our paychecks after that shutdown. So I think the important thing is, much like when you have a hurricane or other natural disaster, that there's a blip in GDP, but that comes back in, so you get that depression effect where you get one quarter down 1% in GDP, then you get the spring load. That money gets fed back into the system. But I think some of the managers that I've talked to, Michael, that they articulated concerns with the tax bill that was passed at the tail end of 17, tax refunds to make sure that those are back. Those are estimated to be $400 positive year over year to each individual in the United States or each filing family. And so that would be an economic draft. But I think the data that we're watching is consumer spending. And if you've been watching that thus far, there's been no impact whatsoever on consumer spending.
Right.
That's the major metric we're watching. We haven't seen that trickle through yet.
Well, and we are at almost 27 days closed. The 1995-96 shutdown, there were 2 of them, 27 days in total. In the total economic cost, there was $1.4 billion. So times are changing. I wanted to...
You and I think we always go back to that Reagan quote of the 10 most feared words in the free world. I'm from the government. I'm here to help you. So, that was the attitude I was at the government. But yeah, the shutdown, I think a lot of people were cheering it at that time.
That's funny. Was that? I assume that was work with the SEC?
Yes, it was.
Yeah, Phil's is one of our SEC gurus, helps us and guides us. Thanks again for that. Getting into the economic charts I sent, one of the ones that I've gone through with clients is I call it maybe the most important chart of the quarter, where it goes back to 1998 and shows the cyclicality of the market in the economy over the past several decades. And you can see kind of the waviness as the dot-com bubble burst, and you had things from investor sentiment and PE ratios that started to slide back and then build again. And then the financial crisis, you saw a pretty significant move downward again, where investor confidence sank and PE ratios were challenged, building all the way back up to where they were in 2018. And then you start to look at some of the data and say, my gosh, we've seen a turn here, most notably in investor sentiment, but really every major economic data point, at least in this chart, shows that there's some level of change with our economic numbers, where it seems like the rate of improvement has started to slow, and that's causing a little bit of potential waviness. If you're looking for a turning point where the economy starts to lose momentum, maybe this is it. What do you guys think?
Yeah, so I'll take that, Phil. This is a really interesting chart, though. This looks, I don't know if this is from Goldman or where this one is from, but I like how they're averaging various valuation, economic, and some technical metrics to sort of, look at cycles across average indicators like this. So I think it's really interesting. I mean, at the end of the day, the way we look at a chart like this and how we feel about where we are in the cycle is you have 4 primary areas that are indicators of economic downturns and therefore bear markets. Those 4 areas are valuations, economics, technicals or sentiment indicators, okay, which are captured here. And then lastly, and most importantly, are liquidity measures. So monetary policy in particular. So economies, I don't remember, Paul Samuelson, right? So one of his many catchphrases is that economic cycles do not die of old age. Right. They're murdered by the Fed in most cases, or financial imbalance. So economics is something we pay a lot of attention to, and I think you're alluding to the fact that a lot of those numbers are decelerating, Michael, and you're absolutely right on that front. We definitely agree with you on that. But how we view those at this stage is that they are decelerating. We look at it more as easing strength. So they're coming from, frankly, like ISM manufacturing numbers, ISM service numbers. They're both coming from unsustainably high levels right now down to expansionary levels still. So until we start to see, particularly here in the U.S., those numbers head a little bit further south, we're still maintaining decent conviction here. Monetary policy, we think, is, of those 4 factors, like I said, the most important. And that's what we feel in the fourth quarter was the biggest driver behind this market volatility that ticked up in October and again in December. You've had 9 Fed rate hikes, so financial conditions are getting much tighter. Credit spreads have gapped out significantly. When you have liquidity being drawn out of the market by rate hikes, and again by the Fed balance sheet unwind, I think that's probably as, if not more important than the decelerating strength that we've seen in a lot of the economic indicators.
Yeah, the only thing I'd add to that, Michael, I think is that if you look at the deceleration, this is a longer term trend. The chart, again, is a great chart. But if you look at some shorter term movements, this is longer cycle and longer moving averages, but if you look at shorter cycles, the drop in ISM and some of the global manufacturing was way worse in 2011 and 2015.
Right.
And those were both 19%. You think back 19% correction in 2011 with the pigs, Portugal, Ireland,
Sure.
Italy, Greece, and Spain, the concern of the viability of the European Union. And then 2015, 2016, where you had China revalue the currency overnight, the S&P was down 10% in 4 trading days, which
Right.
had only happened 9 times in the history of the S&P 500. Those are the types of things in the global economy at that point, but we're in contraction. The global manufacturing went into contraction.
So the argument here is that the economy is notably stronger. The economy is notably stronger.
Those two, yeah, in particular.
And so what you bring up the central bank. So why don't we go? There's a central bank slide that I have where it talks about central banks and market support. I think it's slide 13 if you're looking for a number. But what this shows is that we had for the first time a European Central Bank, Japanese Central Bank, and Federal Reserve coordinated that were pulling money out of the system at the same time for the first time since the financial crisis. So this I think helps provide the data to support what you're saying, and that is this lack of liquidity suddenly provided a real open view to show people just how difficult it is to fight the Fed sometimes, because it seems like that's what we were dealing with in December. So one begins to wonder if the Fed will change their course a little bit. And so there's this chart, and then there's the other, and then I'll turn it over to you guys. The other is a couple slides later. It's the historical Fed tightening and market reaction, and we've had 9 consecutive interest rate increases. And if you look at the scope of that 9 consecutive interest rate increases compared to all the other interest rate increasing cycles going back to 1954, you can see the degree to which the Fed increased interest rates was relatively massive. They did a lot of interest rate increasing work, really late 15, early 16, all the way through to today, and they're shrinking their balance sheet. We're seeing this done on a worldwide basis. So if we can all agree that we shouldn't be fighting the Fed, is there something that gives us hope that we won't be doing that in 2019? Again, 2 interest rate increases, what we're looking at. Is there something that we should really be hopeful for, and should we maybe expect this year?
Yeah, I think that is spot on. There were 2 things you commented on there: the balance sheet, because the Fed really has 2 levers, and so looking back at the back half of 2018 and the narratives coming out of the Fed, what I'll say is this, and I think it's pretty clear that in January here of 2019, it feels like the Fed found religion. It feels like the market told the Fed that enough is enough, pretty clearly.
15% moves do that. Negative 15% moves do that, yeah.
Yes, for sure. Nine rate hikes. And I think the markets were pretty comfortable with the rate hikes up until obviously the 4th quarter. So, looking at 7, 8 rate hikes up until recently, the market's taken them pretty well in stride because the economy could withstand it. There's kind of a difference of opinion in terms of what the financial markets are comfortable with relative to what the Fed and the Fed's models believe the economy can withstand. Mm-hmm. And I think those 2 need to come together a little bit, and I think they began to in January, because the narratives now coming out of the Fed, even from the most hawkish Fed presidents, are now notably more dovish.
Right.
And this is a very constructive development here in January, and I think it's why we've seen a double-digit rally off the early January lows. So 9 rate hikes is one thing. Where the Fed swung and missed on December 19th with the last hike was they made a comment that the Fed balance sheet unwind was on autopilot.
Right.
And that was a pretty cavalier statement looking back, because autopilot $600 billion of fixed income securities into the market is anything that's it's not immaterial. In fact, it's significantly material, to the tune of, back in 2010, William Dudley said that $500 billion worth of QE2 is worth 50 to 75 basis points of accommodation.
Right.
Bernanke in 2011 said that the $600 billion at the time was worth 75 basis points of accommodation. So they're kind of in sync. Therefore, if you flip that and say, now we're down $600 billion already. So we went from roughly $4.5 trillion balance sheet. Right now we're sitting at $4 trillion, just shy of. Mm-hmm. So we've come down $500 billion. That's equivalent to 2 plus rate hikes.
Right.
So the fact that they said, oh, we're just going to keep that on autopilot for another $600 billion, yeah, that made the market a little bit anxious.
Yeah.
But they've come around here in January and not only said that they expect to just kind of wait and see for the first 6 months of the year, but also balance sheet unwind is very much something that's going to be data driven.
Yeah, and Michael, I think the parallels to 2015, 2016, going back to that example of having 2 pronounced double-digit declines in 6 months like we just had here, same thing happened in 2015, 2016. China tightened, or just China tried to revalue the peg on the currency.
Right.
And that caused that quick stop. But probably more importantly was Janet Yellen at the December FOMC meeting, just like Powell just did, said in the face of China collapsing and in the face of oil going from $100 to $30 a barrel, we're going to raise 4 times in 2016. Right? So that was the same narrative. She backed off it on the day the market bottomed, February 12, 2016. Mm-hmm. So the Fed is very powerful. But the other part, I think last year added concern was trade negotiations, the second largest economy in the world, equity prices falling 35%. The concern on global trade clearly, along with the Fed, has caused a disruption in the fourth quarter.
Yeah, and so that's great. Can we pivot from global trade to the global economy? I mean, I looked at the data. There was a piece that Oppenheimer put out. It's a slide 7 for you guys. It shows that the Oppenheimer data suggests that between August and October, the U.S. economy went from a position of strengthening to weakening really within those 2 months. That's what they identified. On the same graph, it shows where the UK and the EU are specifically in terms of economic growth, expansion, contraction. And to me, so there's a few things that I read. I read that the U.S. still continues to be, for the developed world, the stronghold, the single best economy for economic growth and expansion, certainly better than UK and the EU. And I'm sure a lot of that has to do with Brexit. There's just a lot of continued uncertainty in what the politics was happening right now with Theresa May's most unfortunate vote that happened recently. I feel you may or may not have been on a plane to see it, but it has been, it continues to be a real source of frustration. So again, the twofold scenarios. One is that we feel confident that the U.S. still continues to be the place to be. So that's where we will put more of a focus for client assets. And then at the same time, UK, EU, and handicapping the Brexit, because we know that the market fundamentally doesn't like uncertainty. And I don't know how much more uncertainty you can get in that part of the world other than Brexit, when right now it seems that they have a choice of either A, you take a deal with the EU, which, by the way, looks exactly like you staying in the EU, which is part of the reason why that vote didn't go through, or you just leave with no deal and you see what happens. So that's uncertainty on top of uncertainty on top of uncertainty. So how do we handicap all of this, and should we feel really good about U.S. strength relative?
So U.S. versus non-U.S. Growth and non-U.S. uncertainties with Brexit front and center. Agreed. So U.S. growth over non-U.S. growth. Absolutely right. The portfolios that we're working with you on, Michael, are leaning very much toward the U.S. Intentionally. So we're favoring U.S. markets over non-U.S. markets, and that's largely a reflection of our view of U.S. growth relative to non-U.S. growth. I think you can make a pretty strong case that the weakest economy collectively, globally, right now is Europe. And is driven very much partially by Brexit. That's also driven by some other factors. Their economy's been softening for quite some time, whether you look at PMIs, survey data, both hard and soft data in Europe have been softening quite a bit of late. One very interesting anecdotal thing I'll mention, because it's such a big economic driver, is Germany, and specifically the German auto market. So that's something that we've seen some indicators on, and it was actually an EU emissions standard that came into effect in 2018 that had a dramatic impact on the German auto sales. So there was a huge ramp up in auto sales prior to that emission standard coming in. I think it was spring of 2018. That emission standard came into practice and auto sales fell off a cliff because they were so front-end loaded. And they're just now starting to sort of percolate a little bit. So, and you're going to start seeing economic numbers in Europe percolate a little bit right alongside that. So Germany aside, how to handicap Brexit, honestly, our crystal ball gets really foggy when it comes to politics. More so today than ever before, I would argue, so for obvious reasons. So where that goes, we do feel like a no-deal Brexit scenario is a bad outcome. Economically, it's a bad outcome for currency markets. We think you're going to see the pound sterling fall by over 20%. The supply chain disruptions and economic imbalances between a financial powerhouse of London and the continent are really difficult to quantify. So it's something that we're frankly pretty anxious about. That's feeding into our U.S. lean portfolios. March 29th is going to be here real quick. And the likelihood of them beating the deadline of March 29th, which is the expiration of that 2-year window on Article 51, is pretty slim. So that's something that's really difficult, but it's why our portfolios look the way they do. Non-U.S. also, the other thing I'll mention, non-U.S. China. China is huge. As China goes, so too does the emerging market complex. 30% of the emerging market, complex is China, and China drags it both up and down. China and Chinese stimulus responses to their slowing economy have started to become material. This is another constructive observation. So there were 4 cuts to required bank reserves in 2018. They've already delivered 2 additional cuts to required reserves here in 2019. They put forth tax cuts to the Chinese taxpayers, and they're weighing rate hikes as we speak. So they're becoming much more aggressive in response to a bear market in the equity market in China and a material slowdown to 6% GDP growth. So we're looking at that as constructive. Really rare that you actually see the emerging market complex as the best performing asset class in a quarter like the fourth quarter. It was the best performing, the most defensive asset class equity-wise globally was the emerging markets, believe it or not. So that's pretty telling about how the capital markets and financial markets feel about the trajectory there. So the non-U.S., Europe does not look so good. Emerging markets is starting to look pretty interesting, largely because of China and valuations. And then, I don't know, Philip, you had anything to add on that?
The only other thing I'd toss in is there's a price for everything, right, Michael? Where something does get cheap enough, where regardless of how bad the economics are, all the bad news is priced in. And we talked a lot about, and rightfully so, about what's been happening with central bank activity. But that's because there's been an absence of fiscal activity overseas in Europe and in China. Right. And we're seeing signs, to Joe's point, fiscal response. China came out, the bank numbers were pretty mediocre yesterday. And yet China came out with the announcement of a $200 billion stimulus program, and that bid the S&P up by 1% instantly.
Right.
Prop the U.S. market up. And looking at valuations for Europe, Angela Merkel's heir apparent came out on national TV yesterday and said it was calling for tax cuts in Germany. So just going through valuations, emerging markets are trading at 10 times earnings. Europe's now at 11 times earnings, and we're at 14. There's a lot of bad news priced in those stocks. If we get any fiscal response, maybe that might be the call to start putting the toe back in the water.
Yeah, and hopefully that is the case. And I guess it's we'll all see how that shapes up. And a couple of different things I wanted to get your take on. One of them is cash. So, cash is something that for a long time in recent history, in most investors' minds, our clients' minds, it was an investment and asset class that effectively paid you and earned you nothing for such an extended period of time that it wasn't a viable place to put money. It wasn't a viable place to put your 401k dollars in a stable value equivalent money market fund. And it wasn't a great place to put your money in the bank. Banks are still paying very little in terms of interest-bearing savings and checking accounts. But what has changed is that money market has come back in vogue. So, we have money market accounts that are paying 2.5%. If, and it's a big if, the Fed does increase interest rates again by 25 basis points a couple of different times this year, maybe it gets as much as 3%. The challenge that I have is that there are clients now that look at cash as a viable place to put money, and that hasn't been the case. There are clients of ours that are sending us $10 million and more to put in money market and are ecstatic that they're earning more than 2%. They're not, again, our clients, they're not reinvesting in their business. They're not hiring. They're excited about earning this 2%. They're excited at the safety of cash and money market. And so, I have the chart that shows from State Street just how much money's been going into cash, the short-term ETF equivalent. And it's become a place to put money again, and that pulls away from the market. It pulls away from dividend-paying stocks a little bit. So are you guys concerned about cash? What are you seeing with that as an asset class where it used to just be a non-factor?
Yeah, we do. So in our models that we're working with you on, Michael, as you'll probably recall, mid last year, we actually shifted cash to an overweight. So we did begin to build a little bit of dry powder. Now, anecdotally, we put 5% of cash to work in the market right before Christmas in that market downdraft because we felt the market got oversold technically on a short-term level. But we will be returning back to a neutral weight to overweight cash position in all likelihood during the first quarter, because we agree. I mean, if you're getting 2.5% in cash for the first time in almost 9-10 years, you're not losing money on an after inflation basis.
Right.
So real yields right now, for the first time really since 07, are above zero. So that's something that's actually makes it a little bit more of a legitimate asset class to consider in asset allocation portfolios. So that's definitely something that's in play. Are we seeing it in the institutional space? Not so much. We view cash as an asset class along with stocks and bonds. At the end of the day, you can invest in four things. Stocks, bonds, cash, commodities. That's it. Now, if you want to do it in a cute way, you invest in a hedge fund.
Right.
But at the end of the day, you're investing in one of those four things. So to your question, yes, it's an asset class. Yes, yields on the short end of the curve have come up to a point where it's become a legitimate consideration and not as painful as what it had been for the last 10 years. Do I view it as competition to equities? Not so much. Dividend yields where they are at 2% are comparable yields to money markets. So I don't think it's an income competition necessarily. And it's a very different risk profile, obviously, as well. So I don't know if you want to add anything on the cash front.
I think you hit it. I think the one thing we did notice is if you go back when real interest rates, what you can earn in a money market fund gets to more than 1.5%. That's been the clarion call for retail investors and institutions to jump into cash. And in 2007, so Michael, you mentioned earlier the Fed tightening 9 hikes over a couple-year period. It was much more quick in the tightness. The Fed raised 17 straight meetings from June of 04 through September of 06. 17 straight FOMC meetings, hike quarter point every time. Money market funds were yielding 5.6%.
Right.
So we think that now too. So in 2007, everyone talks about retail, the negative stigma of chasing asset classes, but $1 trillion left stock and bond mutual funds in 2007 before the collapse. because you were getting 1.5% above.
Right.
So hopefully, maybe we'll get there. Maybe we'll get there if the economy is good. The Fed raises a few more times. We'll get to a better yield. But yeah, it's looking a whole lot more attractive than it was at zero.
Yeah, 2% real yields. 2% real yields is that's legitimate. That's a legitimate return on your capital. Arguably 2% after inflation. That's above and beyond inflation. We're a ways from there. That clarion call for assets moving into that 1.5-2% yield is one thing. That 2% real yield has also been a canary in the coal mine of economic slowdowns.
Right.
So when short rates get to that 2% level real after inflation, which should be a Fed funds rate right now of about 4%,
Yep.
which we're a ways from, that's definitely another canary in the coal mine of tight monetary conditions leading to economic downturns, which is another thing feeding into our view that we still have a little bit of runway here, albeit cautious.
Cautious, constructive. All right, so let's. There's, we're 30 minutes in, and I really want to make sure that we give some time to what I think is something that could be the specter of a potential problem coming our way. And again, for me, this is about how do we handicap it? How concerned are we? And this is the slide 11, the corporate debt slide. We're always trying to look out and forecast, not so much a crystal ball, but we do try to take a look at the data, see what the data is suggestive of, and are we leaning a little bit more one direction or another. If we thought there was a complete calamity, Joe, Phil, myself, my team, we would look and say, geez, maybe we really need to get out of the way and get very defensive. So we are looking for things that could be potential. I'm not even going to say black swan events because that's too devilish. I just think difficulties that we could be facing. So when I saw this chart on corporate debt, what it shows is the amount of corporate debt that's coming due starting this year, and then again moving forward 2021 all the way through to the year 2050. We all know that what was going on in the low interest rate environment was that corporations were taking advantage of the low interest rate environment, issuing bonds, taking in capital, and they were using that capital in a variety of ways, one of which is that they were, buying shares back of their own stock, right? We know that was a component of what was happening. It made all the sense in the world to borrow when the money was essentially close to free. And when you look at the amount of corporate bonds that are coming due this year, there's very few on a scale. But in 2020, you see a more meaningful amount of corporate bonds coming due. So when we see that, I think back historically to kind of that the charts that I was seeing, and where it causes a little bit of alarm for me is like the residential real estate crisis. When we saw, here are the waves of refinancing that's going to be happening, and we know that the equity isn't there. We know that banks are going to, potentially have some trouble. We can see the waves of refinancing that's coming. This, to me, looks like there's a wave of corporate bonds that need to be refinanced. So corporations will have a choice. Am I going to, when a bond comes due, am I going to give shareholders cash, bondholders cash, or am I going to issue new bonds, arguably at a higher rate? Again, I'm making assumptions that interest rates will be where they are, if not higher, at a higher rate than what they were, which will increase corporate expenses, which won't help a lot with employment or won't help a lot with unemployment. So I'm concerned there. And the other piece of this is that I know a good chunk of these corporate bonds are energy-related companies. And energy-related companies, when oil is under 50, kind of adds just yet another wrinkled layer to this puzzle. And I don't, I'm not sounding the alarm, but I am saying here's an issue where if we're looking to try to identify what could potentially be something significant that could give us cause for pause on the economy, and we're looking at the data, maybe this is something that gives us something to really digest and think about late at night.
Thanks, Michael. So we definitely would, let me color it in a couple of ways. One, the charts that you're referring to, and I'm not sure if your clients are able to see the chart, but the chart looks at the forward calendar maturity, year-by-year maturity calendar. And, we talk to managers, fixed income managers all the time, and this chart we see in almost every pitch book of managers that are pitching stressed, distressed, and high yield.
Yep.
So they're pitching protection. When I show this chart to managers today, they have two comments. One, they say unequivocally, this is not an abnormal calendar profile, okay? A forward calendar profile. There's always a small mammal working its way through the snake in terms of refi risk.
I like that. I like that imagery. Thank you. Yeah.
It's always there. It's every year. It's always, you can always see that happening. But what is abnormal is the overall amount, the aggregate amount of issuance, which you've highlighted. So therein lies the refi risk. The refi risk of rolling that amount of debt. So absolutely. And the complexion of the debt and the holders of the debt are the two other considerations. The complexion of the debt, no question, is much more speculative today than what it was 10 years ago.
Right.
So investment grade debt has gone from $1.9 trillion to $5.1 trillion over the last 10 years.
Right.
Investment grade, okay? Back in 2008, 33% of that investment grade was single A or on the fence of being downgraded. Today, that's 50%.
Right.
So there's much more, call it questionable investment grade debt issuance out there. The debt to EBITDA coverage is much thinner today. So it right now is 2.3 debt to EBITDA. It was 1.6 back in 2009. And interest coverage also is much skinnier. There's not as much coverage on interest. Interest coverage has gone from 17.4 down to 14.3. So the quality, the complexion of the debt is definitely weaker. The amount of the debt is concerning. The big difference between today and the GFC, the financial crisis back in 2008, is the third. It's the holders of the debt. The holders of the debt back in 2008 were leveraged entities,
right?
Banks. There are no more leveraged corporations than banks. Financials are the most highly levered companies that are out there in the economy. When they hold paper that's massively deteriorating, i.e. resi paper back in 2008, there's a big problem, a systemic problem. Holders of the debt today overwhelmingly are not banks. They are non-banks. They are shadow banks, they are pension funds, they are insurance companies. So that is definitely a comfort food, a very soothing anecdote to, equate this not to the GFC, but rather to investors that are much more likely to hold the debt through any sort of market disruption. So Phil, I don't know if you want to comment on that as well.
No, I think the only thing I'd add to that, Joe, is that back in 2007, Michael, that chart looked eerily similar to 2007, the magnitude of the next 3 years, a ton of maturities. So in that time period, it's not just the interest payment that you're paying, but can you refi?
Right.
Is there enough comfort in your ability to pay back that and float new bonds? In 2006 and 2007, 10-year bond yields were at 5.5.
Right.
Right now we're at 270. So if you came out and issued new bonds, if this was 2020 and we're still at 2.7 or 3 on a 10-year with that handle, you can refi that easily because it's the same debt burden that you have now.
Right.
But if the Fed continues to raise, that'll be even more of a problem, though.
Yeah. A huge amount of the debt that has been issued, Michael, which you pointed to, that's overwhelmingly non-financial debt. So those are not banks have been forced for regulatory reasons to de-lever in large scale. So they're much healthier balance sheets. The debt that's out there is non-financial debt, which has been used for dividends and buybacks, no question. It's not necessarily the most productive uses of the debt, but again, the end holders of the debt are not levered entities, and we're viewing the overall credit situation, the overall debt situation. When you look at public debt versus corporate debt and household debt looks good.
Yep.
That's largely because the mortgage overhang has been written off over the last 10 years to a large extent. corporate debt has been ballooning. It's been non-financial and it's held by non-levered entities. And then government debt, the third, that one.
That's a whole podcast. The government debt's a whole podcast.
That is a whole podcast.
Yeah, I mean, right. And so I'm on the same page. So it's the kind of thing that we're telling clients if it becomes a looming or growing issue where we see potential problems with the refinanceability of some of these bonds, then we'll react accordingly. I do want to close the loop on just with munis. I'll just get a quick note. We saw some good discounting on munis. We've seen a nice rebound there. We continue to be positively constructive on munis. We're seeing residential real estate inventories climb, which should lead to some softness in prices. And, so again, we're encouraging clients that, those that are thinking about selling real estate in most circumstances, hurry, go ahead and do so, because it doesn't appear to be getting any better anytime in the very near future. And so, what I would like to say, in my kind of closing comment, I'll turn it back to you guys, is that, 2018 was the first time in 27 years that both stocks and bonds declined in the same year. So, we're always looking, to be contrarian from the perspective of when does it make sense for us to jump in or be more constructive. For most clients, we took risk down in September, which was good. And as Joe mentioned, late in December, starting to put a little bit of risk back on. We continue to be constructive on the market. It seems like we're all speaking about the same thing here. In 2018, with the kind of year that it was, seemed to be pricing in a type of recession and fear and anxiety that we need, that doesn't seem to be coming to fruition. I mean, again, we have to work out the tariffs. We have to work out the Fed, make sure they continue to behave. But with that, it seems the message here is constructive. Now, so in 60 seconds, are you guys able to kind of give us just a very short, brief, little beautiful wrap up of how you guys feel? Phil, yeah. Go ahead.
Maybe I'll take a quick whack at it. And if you go back with 100 years worth of data, stocks have returned 10% a year. 90% of that is from what's happening with the economy, sales plus profit margins.
Right.
That's over any rolling 10-year time period. Over any 1-year time period, it's fear and greed, PE multiple contraction expansion. This was one of the biggest drops, the third biggest drop in 50 years in PE multiples. Mm-hmm. Profit margins skyrocketed. Earnings were up 25%. And yet we had a 5% or 4.5% drop in the S&P 500. Markets do focus in on fundamentals, but
right.
A lot of the headwinds that you're talking about will be problems 2020, 2021, 2019, whether it be earnings, top line sales, and all the stimulus that's being jacked into the system. Yeah. We think over a shorter lens here, that's the reason to be a little bit more constructive over the next 6 to 12 months.
Joe, you got less than a minute. Have you ever done anything in less than a minute? Just be clean about it.
Phil and I speak with the same language, the same party line. We've been working together for 20 years, Michael. So what he just said, I'd echo what you said. I think you definitely see the world and the markets very much in sync with our views, which is great. And when we don't, we'll figure out how to navigate things.
We'll hash it out.
I think constructive 6 to 12 months, and we really appreciate the relationship with you, and ultimately, on the look through to all your clients as well.
Absolutely, guys. Thank you so much for your time. This has been the first quarter market outlook for 2019. Joe, Phil, you guys are amazing. I look forward to talking to you guys sometime soon, and I'm sure I'll see you soon. Take care and have a great day.
Cheers.
Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities. Member of FINRA and SIPC.